So welcome everyone to iRate IRAs. Very unique title that Austin came up with, and it has a dual meaning of that I can rate IRAs for you and teach you about them, but also I've noticed that IRAs can make people irate because they can be really confusing. So I'm hoping that this presentation will clear up questions maybe you've had about IRAs. It's going to be a very 101 class. So there might be a lot that you guys already know, but I do think it's always good to reinforce that. All right, an IRA is an individual retirement account. And it's a tax-advantaged account that individuals use to save and invest for retirement. I'm going to break up this definition to better explain all the different components of the IRA. So an individual retirement account is a tax-advantaged account. This might seem like an obvious thing to say, but I find that a lot of people get confused and will say, I want to invest in an IRA. And they believe that an IRA is an actual investment, like 100 shares of Apple stock. And I see them get frustrated with that because they think that they can buy an IRA when really it's an account that you have to open. To demonstrate this, I'm using bowls, which might seem a little silly, but it's a way to visualize that an account is something that you put things inside, that you open up in your name. The most common account that in the financial world that people open up is a checking account. There's also savings accounts, and then there's an IRA account. So I am doing this visual to help people understand that it's a separate bucket that you put investments in. So with those three types of accounts, what do you put inside the bowl? With a checking account, it's cash. With a savings account, it might be money market or CDs, which neither are paying very well right now, but it's typically an interest-bearing type of investment. But in an IRA, that is where most people do investing. And so inside the IRA will be stocks, bonds, mutual funds, exchange-traded funds, things like that. IRAs are tax-advantaged. Now, what does that mean? By being tax-advantaged, the investments inside the IRA account grow tax-free, which means the interest that you earn, the dividends that your stock investments pay, and the growth of those underlying investments are not taxed until withdrawals are made, typically in retirement. This is great because if you had a brokerage account where you own some stocks and bonds, you would get a 1099 every year where you would have to pay tax on what you've earned, meaning the interest and the dividends. And then if you sold an investment that had gained in value, you'd have to pay capital gains on it. So by using an IRA account, this is something the IRS and Congress approved years ago. It's a wonderful way to have that money grow and grow and grow. And what you would have paid in taxes is actually going to help the growth of the account. Now, qualified withdrawals from a Roth IRA are tax-free in retirement when you take them out. But the other types that we'll be talking about, when you do make the withdrawal, that's when you get taxed on what you take out. IRAs are for retirement. That means that you should wait and not take money out of IRA accounts until you're 59 and a half. Very strange that they picked 59 and a half, but that's the number. And it's important to know this because if by chance you plan to retire early, before the age of 59 and a half, an IRA might not be the best thing for you. When people invest in 401k accounts or 403Bs or deferred comp at work, those type of accounts often let you withdraw money at age 55 if you retire. So there's an interesting window there of 4.5 years where if I'm talking to anyone that wants to retire early, I make sure they know that the money should maybe stay in the 401k until they turn 59.5. Early withdrawals have 10% penalty as well as the tax consequences that happen when you pull the money out. So it's really good idea that you use these accounts for retirement. Okay, the types of IRAs that we're going to talk about today are traditional, rollover, Roth, and inherited. There are other types of IRAs that are for businesses, like SEP, Simplified Employee Pension, and then also there's simple IRAs, and those are for businesses as well. But this presentation decided to focus on the accounts that individuals open. Before I dive into the different accounts, I wanted to clear up contributions versus rollovers. So there are two different ways that you can fund an IRA account. And the first one is contributions. And this would be, okay, I'm going to start putting money aside for my retirement at $200 a month. Open an IRA account and then move $200 a month into this IRA account. That is a contribution. And the IRS limits how much you can put in an IRA every year. Currently, the limit is $6,000. And if you're over the age of 50, you can put in $7,000 a year. Might seem like a small amount. You can put in a lot more in 401k accounts. But because of their tax advantage nature, it's more for the small investor, and they don't really want the multimillionaires using this as a tax shelter. So they do limit the contributions annually. Any age can open and contribute to an IRA account. But here's the key thing. You have to have earned income. So these accounts are meant for workers. It doesn't count if you have dividends and interest or rental income, or let's say you get a pension payment. You can't turn around and put those into an IRA. You actually had to have worked at a job doing something where you got paid, and that's the money you use to contribute to an IRA. And it is limited to what you make. So a 16-year-old, if they wanted to put $6,000 into an IRA, the only way they could do that is if they earned $6,000. So if they only earned $2,000, they can only put in $2,000. Rollovers are very different. Rollovers, it's when you have monies that you've already accumulated in another account and you move it or roll it over into a new account. This is very typical when someone retires. They will have a 401k at work, and let's say it's built up to $300,000 that's in that account, but then they want to take control over it in their name, in their own IRA account. Then that's when they roll over that $300,000 into an IRA. And there's not a monetary limit on how much you can roll into an IRA. But there is a caveat of the IRS will only let you do one per year unless it's a direct rollover, and that's from custodian to custodian. So from Fidelity to Schwab. If it goes direct like that, you can do more than one. But if you're doing an indirect rollover, you can only do one per year. All right, now we're going to get into the different types. The first type is a traditional IRA. This is a good choice for getting a tax deduction now. So if you are wanting to save for retirement and you want to reduce your tax bill that you have to pay in 2021, then you use a traditional IRA to contribute money to it, and then dollar for dollar, that will be taken off of your taxable income. When you go to pull money out of a traditional IRA, it will be taxed. So it's a save taxes now, pay taxes later. Whether or not you can deduct this money can be a tricky bit of a calculation. I am going to show you the table, and I don't want you to get too wrapped up in it, but you do want to check with the tax program that you're using or with the CPA that helps you with your taxes. What the IRS restricts is if you have a retirement plan available to you at work. Meaning if you work for XYZ company and they have a 401k plan that you can participate in. If you have that plan available to you, they limit how much deductibility you can have with your IRA contributions. But if you don't have a plan available to you at work, then whatever you put in is deductible. But let's look at the chart of, let's say you do have a plan available at work, but you'd rather just do your own thing. Now, this is a lot of information, but you look first at your filing status of, do you file single, married filing jointly, or married filing separate? If you are single and you earn $66,000 or less, and this is your modified adjusted gross income, if you earn $66,000 or less, you can fully deduct your IRA contributions. But once you get higher than that income, it starts reducing the amount you can contribute. And once you're over $76,000 in income, you can't do it. You can't deduct what you put in a traditional IRA. And then that's when I tell people, okay, you need to go the Roth IRA route or just stick with the plan you have at work. Married filing jointly, a little bit of a higher income that allows it. Married filing separately, IRS hates people that do married filing separately and punishes them with all these IRA accounts. So if you earn $10,000 or more, they're not going to let you do an IRA deduction if you do married filing separately. So that's a big warning I like to give people because some people file separate just to save a little bit on state taxes, and then it kind of gets ruined when they can't deduct their IRA contributions. All right, again, traditional IRA is save taxes now, pay taxes later. Your withdrawals are taxed at your ordinary income rate. So that's that tiered chart that we're used to of the more money you take out, then the higher of the percentage it could be that you'll be taxed at. And with traditional IRAs, they have required minimum distributions, or RMDs. The law changed to where now if you are 72 years old or older, you have to pull money out of your IRA. And you think, why? If I don't need the money, why do I need to pull it out? Well, it's because Uncle Sam wants his share. And you've been able to enjoy this tax-free growth, let's say from age 30 all the way up until 72. Well, now they want their cut of it. And your required minimum distribution is calculated by a life expectancy table. It can be a little confusing. Typically, lean on an advisor like myself to determine what that RMD will be. Okay, traditional IRAs are often open to accept rollovers from prior employer plans, like I mentioned, 401ks, 403bs, deferred comp. And if it's opened as a traditional IRA, you have the option of continuing to add to that. So say you worked at XYZ company, you quit, and now you're working at ABC company. You roll over your old 401k into a traditional IRA. And this new company doesn't even have a retirement plan. So you take it upon yourself to keep adding to this traditional IRA at $6,000 or $7,000 at most a year. This is very different than a rollover IRA. And this confuses people often. The rollover IRA was created to accept rollovers from a prior employer plan. So that in that way, it's just like what I just said with the traditional IRA. But with a rollover, you do not add money to this. It is meant to stay as a pure account that accepted a rollover from another plan and that can then stay in its pure form to roll out to a new employer. if you so desire. Not many people do that, but there are circumstances where people do want to keep that money and they can't directly take it from XYZ 401k to ABC 401k. And so in the middle, they can put it into a rollover IRA. Another reason why people will title the account as a rollover IRA is they may have a traditional IRA that they added to and they did not get a tax deduction for. And so now they've commingled money in this traditional IRA, and come age 72, they're going to have to tell the IRS, this part's taxable, this part's not. But with a rollover IRA, they know for sure that came from their old employer and 100% of that was put in pre-tax, and they will have to pay taxes on 100% of that rollover IRA. I will tell you, I don't use rollover IRAs very often, but it is available for those that need some different techniques. The rollover IRA has the same contribution limits, tax structure, and the withdrawals are just the same as the traditional IRA. All right, now let's get on to Roth IRAs. They have become very popular, especially with younger individuals. And anyone I work with that's under 40 years of age, I bring up Roth IRAs as an option. And even at younger than 50. But it is an option that's open to anybody who has earned income. So you don't save any taxes by putting money into a Roth IRA. You've earned the money and you've received your paycheck, and it's already payroll taxes have taken out FICA and all of your federal tax. And so now you have the money sitting in your checking account. And when you contribute that to a Roth IRA, you get zero, nada with tax benefits. So some people think, well, why in the world would I want to do that? Well, it's because you will never pay taxes on that account again if you follow the rules. So that means you could start with contributing $6,000 a year in your 30s, and it's going to grow and grow and grow tax-free. And then when you retire and go to pull the money out, tax-free, zero taxes. So I really do like that when people have both a traditional IRA and a Roth IRA, because the Roth IRA will give you freedom. Let's say in a year, you've already pulled out your RMD for your IRA account, your traditional IRA account. And so that has put your taxes at this certain level. And if you need to pull out an extra $5,000 for a vacation, that could send you into the next tax bracket, or that could send you into the next bracket where you're going to pay more in Medicare, or you just don't want to pay more taxes. Then you, by having that Roth IRA as a diversified source of funds, you could pull the $5,000 for the vacation from the Roth IRA. So they are very handy to have. So your withdrawals are not taxed at ordinary income as long as you follow the rules. And here's another big bonus of Roths. They do not have RMDs. So when you turn 72, you're not forced to take any money out of those. They also make for a great account for you to pass on to your heirs, because not your heirs also will not be taxed on pulling the money out of the Roth IRA as long as they follow the rules. Okay, so side by side, let's look at traditional versus Roths. Traditional, tax deduction today. Roth, no tax deduction today. Traditional withdrawals are taxed as ordinary income. Roth withdrawals are not taxed. Traditional, you have RMDs. Roth, no RMDs. So that's a summary of the difference between the two most popular IRAs that are out there. Okay, I kept saying as long as you follow the rules. Here are some Roth IRA rules. You can always pull out your contributions with no tax or penalty. Okay, what does that mean? It means if you put $6,000 into your Roth account, later you have an emergency and you need that money back, you can take back that $6,000 with no tax, no penalty. However, if that $6,000, because it's been invested, has grown from $6,000 to $7,000, you can't touch that $1,000 of growth without it being taxed and penalized. So it's very important to keep good records about what your contributions have been versus your earnings and growth, so that you can justify to the IRS if you ever do need to pull those contributions out. There is a form that you can file every year you make a contribution to a Roth IRA. It does nothing to your taxes, but it sort of starts an official record with the IRS of what your contributions have been, and it will help you justify it if you ever wanted to pull them back out again. Now, if you're over 59 and a half and you've had your Roth IRA account open for at least 5 years, then you can withdraw both the contributions and all the earnings and growth with no tax, no penalty. So it's an interesting kind of tricky rule, that 5-year thing. So anyone that's thinking about doing a Roth IRA, I say, you know what, start it as soon as you are thinking about it, even if you only put $1,000 in it, because that starts the clock ticking. So you won't have a problem meeting that 5-year rule. Now, if you're under 59 and a half, or you don't meet the 5-year rule, there are some special exceptions of pulling the money out, such as if you're a first-time home buyer. And I have had clients that have used that, and they just, again, pull out the contribution, and even the earnings, they don't need to worry about it, because then they can dub it as the first-time home purchase, and they're safe. I've even known people that use Roth IRAs to save for their child's education, because they know that they can pull those contributions out later. But it could be they know their kid might get a scholarship or take out loans or things like that. And then, great, this is more money for retirement. Okay, so with Roth contributions for 2021, you can do $6,000 a year, $7,000 if you're over 50. Again, you have to have earned income from a job that's equal to or greater than your contribution amount. And then the last thing that is a bummer is there are income limits. And this is the IRS not wanting the ultra rich to use these accounts as tax shelters. These are for the middle class working folks. And so if you earn too much money, you can't contribute to a Roth. So here are the income limits for the Roth. If you are filing single, if you earn under $125,000, you're fine. You can do the max contribution and you're good. And I do want to clarify though, let's say you're on this trajectory of a career and right now you earn $100,000 and you're like, great, I can do a Roth. And then you earn 110, you can still do the Roth. Then all of a sudden you get a raise and you're at 130,000 and you're like, at 130,000, you could do a partial contribution. But if you get over 140, you can't add to the account anymore. But that doesn't mean that you can't still have that account. So all those years that you did contribute to it and you have investments in there, they will continue to grow and earn money, and you'll have that account available to you in retirement. You just can't add to it once you're making over 140,000. But if you're married filing jointly, that goes all the way up to 208,000. And this is adjusted every calendar year. The IRS puts out new income limits. So sometimes people skirt right under it year after year. And again, married filing separate, they really punish you. They don't want you to be able to add to a Roth either. Okay, inherited IRAs. This is when a loved one passes away and then they have named you the beneficiary of the IRA. And it could be that it's a parent and there are 3 siblings and it's divided evenly between the 3 siblings. And each one of those siblings would need to open an inherited IRA in order to move the money from their parents' IRA into their new inherited IRA. If it is a spouse that has passed away, you can actually roll that money into your own personal IRA, but it's only if it's a spouse. So otherwise, if it's a non-spouse, you have to open the new inherited IRA account. The IRS and Congress, they decided on a new rule with inherited IRAs, and it's a tough one. It really is. So any inherited IRA that was opened after 2020, or it could be 2019, I apologize that I might be getting my years mixed up, but they have to withdraw the funds within 10 years. It used to be that you could stretch it out over your entire lifetime. When you had this inherited IRA, they used the life expectancy table on you. And so as a 51-year-old, my life expectancy would be 80 something, and I could stretch it out over 30 years. Well, they decided they wanted, Uncle Sam wanted their cut. So now you have to withdraw all the money within 10 years. For big accounts, this could be a burden. Let's say there's a $1 million account that you inherit and you think, ooh, this is wonderful. What that means, though, is you're going to need to pull out $100,000 per year and pay taxes on that. So it's going to jump you into the next tax bracket, or maybe two brackets. And it could also affect your Medicare payments and things like that. So it is a new planning challenge that is in the industry now with these inherited IRAs, that you have to pull them out. Well, I want to thank all of you so much for joining me for this presentation about IRAs, and hopefully you're not irate anymore about IRAs, and that it has cleared up some things for you. And in this slide is my contact information if you need to get a hold of me. Thanks so much.